Dear viewer, welcome to our channel GVS Bank Academy. Now I am going to discuss about JAB accountancy paper number 2, 2 marks recalled questions and practical questions. Practical questions 2 marks. This will be very useful for preparation of coming examinations. Question number 1. In Mumbai foreign exchange market, $1 is equal 75 rupees 40 paisa buying rate. $1 is equal 75 rupees 40 paisa bank buying rate. 75 rupees 50 paisa bank selling rate. Bank is buying 75.40, bank is selling 75.50. Bank customer want to buy $1,000. For purchase of $1,000, how much amount of party had to pay to the bank in INR? This is the question. So customer is buying means bank is selling. Selling rate you have to take. $1,000 into 75.5. Why 75.5? Customer is buying means if customer want to buy the foreign currency means bank has to sell. So bank rule is buy low, sell high. So sell high 75.50 into $1,000. So customer has to pay to the bank for $1,000 75,500. 75,500. This is a good question. Question number 2. Face value of the bond 1,000. Face value of the bond 1,000. Coupon 10%. Face value 1,000. Coupon interest rate on the bond is 10%. So every year the bondholder will get 1,000 rupees into 10 means every year he will get 100 rupees. 1,000 into 10 coupon percent 10 means rate of interest he will get 100 rupees per year. Maturity of the bond is 3 years. The term to maturity of the bond is 3 years. Discounting rate or present market rate in the market discounting rate YTM 12%. 12%. Coupon payment half yearly. So against this bond interest payment is half yearly. So half yearly means coupon yearly 10% means half yearly means 5%. Half yearly means 5. 1,000 into 50. 1,000 into 5 means 50. For half yearly the coupon payment on this bond is 50 rupees. Interest payment is 50. The maturity of the bond is 3 years. 3 years. 3 years means first half year 50 rupees you will get. Second half year also you will get 50. Third half year you will get 50. Fourth half year you will get 50. Fifth half year you will get 50. Sixth half year you will get 50 plus maturity value of the bond 1,000. At the end of 6th year you will get the coupon is 5% 50 plus face value maturity value is 1,000 1,050. This is the inflow against this bond. First half year, second, third, fourth, fifth and sixth half year. Now discounting rate is 12% per year. Half yearly 6% you have to take. Half yearly 6%. So how you will get the present value discounting factor for the first half year is equal yearly 12 means half yearly 6. 1 by 1.06. 1 divided by 1.06. You will get 0.9434. You will get 0.9434. How you are getting? Yearly 12% means discounting rate for year is 12 means half yearly 6%. 1 divided by 1.06. You will get 0.9434 first half year. Again Second half year, press is equal 1 by 1.06 is equal first time 0.9434. Second time is equal 0.899. Third time 0.8396. Third half year. Fourth half year 0.7921. Fifth half year 0.7473. Sixth half year 0.7050. How we are getting once again? Yearly discounting rate 12 means half yearly 6. 1 divided by 1.06. 1 divided by 1.06. Press is equal. First half year you will get. Again press is equal second half year. Again press is equal in the calculator you will get. Again is equal to fourth, fifth, sixth you will get. Multiply 50 into this figure. Accordingly you have to multiply this figure. After multiplication you can add all these figures. All these figures, amounts we can calculate. You will get a total of 954.65. 954 you can add 1, 2, 3, 4, 5, 6 add you will get 954.65 you will get. Present value of the bond is 9054.65. What is the face value? 1000. What is the present value? 954. The bond is quoting less than face value. The bond face value 1000. Present market rate is, present value is 954. Why? The reason is, against this bond, the bond holder is getting 10%. On this bond, the coupon rate is 10%. 10% yield. But in the present market rate is 12%. So, present market rate is more than the coupon rate. Present market rate 12% is more than the coupon rate of 10%. The bond price is going to be quoted at discount. Present discounting rate is more than coupon rate. The bond price is going to be quoted discount in the market. This is the discount. Face value 1000. Present value 954.65. This is about 2. Face value, this is question number 2. Question number 3. Face value of the bond 2000. Coupon 8%. Coupon means interest payment 8%. 2000 into 8 per year 160 rupees you are getting. Interest amount 160. How? 2000 into 8% 160. Now present market rate of the bond is face value 2000. Present market rate is 1800. It means this bond if we can purchase it is available 1800. At the rate of 1800 of the present market, what is the current yield? Latest yield current. The formula is 160 divided by 160 the coupon 2000 into 8%, 160 divided by the present market 1800 into 100, 8.88. Coupon is 8 against this bond. Current yield is 8.88. Why the current yield is more than coupon? Because the face value of the bond 2000, if we can purchase in the market, we are getting at 1800. Our investment is 1800. You are getting coupon on 2008%. 160 divided by 1800 into 100, 8.88. This is the present current yield. Fourth one. Cost of the machinery is 10 lakh rupees. Cost is 10 lakhs. Cost is 10 lakhs. Life of the machine is 10 years. 10 years. 10 years. Using sum of years digit method, calculate depreciation for the third year. Machinery cost 10 lakhs. Life 10 years. Using sum of years digit method, calculate depreciation for the third year. So, this is the question. How we are going to answer? Sum of years total you have to calculate first. 10 years means 10 plus 9A plus 8 plus 7 plus 6 plus 5 plus 4 plus 3 plus 2 plus 1. That is 55. So 10 years, in this manner you have to calculate sum of years digital total. 10 plus 9 plus 8 plus 7, 6 accordingly. Now this is the sum of years digit total is 55. We had calculated. Now they are asking calculation depreciation for third year. This is for first year. First year 10 you have to take. Second year you have to take 8, 9. Third year you have to take 8. Fourth year you have to take 7. Fifth year you have to take 6. In this manner, for the third year you have to take 8. 10 lakhs. Depreciation for the third year is equal to 10 lakhs. 8. 80 means the sum of it is total may 8 for the third year. First, second, third. 8 by 55. Sum of it is total 55. So third year depreciation is 1,45,454.55. 1 lakh. Now what you have to do under this? First you have to do this. 10 years digits you have to calculate. 10, 9, 8. Your entire calculation will depends upon this. First year means 10 lena padega. 10. Second year 9. Third year 8. Fourth year 7. Fifth year 6. In this manner you have to calculate. This is the fourth question, important question. Fifth question, very useful and important. NPA. NPA date is 34/2019. 34/2019 NPA date. Outstanding is 40 lakhs. Ledger outstanding balance is 40 lakhs. In this 40 lakhs, unrealized interest 2 lakhs is there. 40 lakhs. Unrealized interest means interest which was debited in the borrower account but not recovered. That is called unrealized. Interest debited but not recovered 2 lakhs. That is the 40 lakhs, 2 lakhs, including 2 lakhs. This value of security 20 lakhs. In this borrower account, value of realizable value of security 20 lakhs. Calculate provision on doubtful accounts 2. Doubtful 2. Now first you have to know what is doubtful, substandard, doubtful. Substandard account means from the date of NPA 1 year. Date of NPA is 34/2019. Up to 1 year means 29/4/2020 substandard account. 1 year. Substandard 1 year. After that the account migrate to doubtful 1. Doubtful 1 means 34/2020. 34/2022 1 year. Doubtful 1 year. 29/4/2021. Doubtful 1 year only. That is up to 29/4/2021. After that, after completion of 1 year in D1, the account will migrate to doubtful 2. That is 30th April 2021. For 2 years means 29/4/2023. The account shall be there in doubtful 2 category. 2 years. Substandard 1 year. Doubtful 1 year. Doubtful 2 years. 2 years. 29th April 2023 up to the account is there in doubtful category. This is the question. Now, total outstanding balance is 40 lakhs. Out of that, unrealized amount is 2 lakhs. This, when the account turned to NPA, this amount has to be reversed to P&L. This account, again, whatever the interest amount debited, that amount you have to credit to interest account, borrower account, and debit to P&L. So 40 lakhs minus 2 lakhs, 38 lakhs only. This has to be reversed to P&L. This is. So after reversal of URA, net outstanding balance ledger is 38 lakhs. 38 lakhs. Then provision on doubtful 2. That is the account is there presently doubtful 2. Doubtful 2 provision, secured advance on the secured portion 40%. Unsecured portion 100%. So on secured portion amount 20 lakhs into 40%. Doubtful to NPA category secured 40, 20 lakhs into 40, 8 lakhs. Unsecured 100%. In this case, outstanding is 38 lakhs, security 20 lakhs, unsecured is 18 lakhs. 18 lakhs means 100% means 18 lakhs. 18 lakhs plus 8 lakhs, total 26 lakhs provision. In this category, in this example, provision is 26 lakhs. A little bit criticality is there. URI, unrealized interest. This amount, whatever included in the ledger account, that has to be reversed to back to P&L. That's why 40 lakhs minus 2 lakhs. For all the purpose, you have to take 38 lakhs. This is about one more thing, substandard 1 year, doubtful 1 year, doubtful to 2 years. That is it. After doubtful to 2 years, the account will migrate to doubtful 3. Doubtful 3 provision is doubtful 3, secured, unsecured 100%. Opening stock 240, closing stock 360, cost of goods sold 3000. Calculate stock turnover ratio. Opening stock 240, closing stock 360, average stock is 300. 240 plus 360, 600, 300. Cost of goods sold is 3000. Stock turnover ratio formula is equal cost of goods sold by average inventory. Cost of goods sold by average formula. This is there. Stock turnover ratio is equal cost of goods sold 3000 divided by average stock 300. So stock turnover ratio 10 times. In a year, stock is moving out 10 times. In a year, in that company, the stock is moving 10 times in a year. So, stock holding period. What is the stock holding period in months? On an average, in that firm, what is the stock holding period in months? In months. 12 months in a year divided by 10 times, then 1.2 months. On an average, the stock holding period in the company is 1.2 months. For all the purposes, stock holding levels always lower side is best. Stock holding period in months or days, lower side is best for efficient management of stock. This is about stock turnover ratio formula, cost of goods sold by average inventory, that is important. Term loan 135. Capital also 135. Reserves 112. Machinery 121. Goodwill 18. Net profit for the current year. Net profit during that year 112. 112. Now term loan 135. Capital 135. Term loan is long term liability. Capital and reserves part of tangible net worth or net worth. Capital reserves 135 plus 112, that is net worth. Net worth of the company, capital of the company is 135, 247, 247. Tangible net worth. Net worth minus intangible assets. Net worth minus fictitious assets. 247 minus 18. Goodwill is 18. Goodwill means intangible assets. Goodwill is a real account. Intangible assets, real account formula. Debit what comes in and credit what goes out. In the company account balance sheet, goodwill is part of fixed assets. That is also. Now, tangible net worth is 229. 229. 229. Now, current year profit is 112. How much investment they had made? Return on equity. Equity net worth of the company is 229. And how much net profit they got? 112. What is the return in percentage? Tangible net worth. Return on equity is equal. Return on equity is equal 112. That is net profit for the current year divided by tangible net worth 229 into 100. Return on equity or return on tangible net worth is equal to net profit 112 divided by tangible net worth 229 into 100, 48.9. We can also take here net worth also, but better to take tangible net worth. It is best. This is the. Now, eighth. Current assets are 8,000. Current assets 8,000. Fixed assets 6,000. Intangible assets 300. Intangible. Capital and reserves 4,000. 4,000. Net worth 4,000. Long-term loans 6,000. Payable after 1 year from the date of balance sheet. Current liabilities payable within 1 year or within 1 operative cycle. Current liabilities. Fixed assets permanent in nature. Benefit you will get long term. Fixed assets always capital expenditure. Current assets receivable within 1 year or 1 operative cycle from the date of balance sheet. So this is there. Now tangible net worth. Tangible net worth is called net worth, capital and reserves. This is 4,000 minus intangible assets 300. Capital reserve 4,000 minus intangible 300. That is 3,700. Tangible net worth 3,700. Okay. Then calculate debt to equity ratio. Debt means long term. Long term loans 6,000. Debt means long term loans. Debt long term loans 6,000 divided by tangible net worth. Tangible net worth 3,700. So debt equity ratio 1.62 is to 1. 1.62. 1 rupee capital 1.62 long term loans. 1 rupee capital 1.62 paisa long term loans. Net working capital NWC net working capital current assets minus current liabilities. 8,000 minus 4,300. 3,700 is the NWC net working capital. Current ratio current assets by current liability. 8,000 by 4,000. 1.86 is to 1. 1 rupee current liability, 1.86 rupees current assets. This is called current ratio, short term solvency. Normally required current ratio is 1.33 is to 1. 1.33 is to 1 normal required. Gross working capital, total of current assets 8,000, 8,000. Net capital employed. Capital employed is equal to net worth 3,700. This is owner's funds. Shareholder funds 3,700 plus long term loans borrowed funds. Borrowed funds long term loan 6,000. 6,000 plus 6,000 plus 4,000 minus 300, that is 9,700. How 9,000? Capital 4,000. Long term loans 6,000. 10,000 minus intangible assets 300. This example is very, very useful. We are discussing 6 problems, compulsory questions. As on 31st March 2020, capital 300, reserves 400. So both net worth 300 plus 400, 700. Sales during the year 2,000. Sales in the 2,000. Direct expenditure 1,000. Indirect expenditure 700. Tax rate 25. Calculate net profit after tax. Now, total sales 2,000 minus direct expenditure means direct expenditure is always debited to trading account. Direct expenditure means wages, power and fuel, carriage inward, carriage outward, transportation, that is called related 1000. Sales 2000 minus 1000, that is direct expenses are going to be debited to trading account. Trading account debit side, direct expenditure. Indirect expenditure, P&L account, nominal P&L debit side. So sales income 2000 minus direct expenditure 1000 trading account minus indirect expenditure P&L account 700. Profit is 300. Net profit before tax is 2000 minus 1700, 300. Net profit before tax. Tax is 25. So tax amount 3000 into 25, that is the tax at 75 rupees. Net profit after tax 300 minus 75, 225. NPAT, this is it. Now one more assumption. If the entire amount was invested, retained in the business, what is the tangible net worth as on 31st March 2021? This entire net profit was retained in the business. That is called profit retained, profit invested. So profit was not withdrawn. That is there. That is capital, opening capital 300, reserves 400, plus net profit after tax 225, total 925. So profit is there 225, entire amount they had invested, retained in the business, that is going to be added to net worth. That is this. These are the questions which are very useful for the accountancy practical examinations. Thank you very much for viewers. We are conducting online classes for JAIIB, CAIIB and promotional exam also. Interested participants are requested to contact.